Hello traders, you're welcome back to the Forex Geek channel. In this video, we're just going to be discussing stock swing trading strategy. So if you're looking to take your stock trading to the next level, then you are in the right place. Okay, this strategy is going to help you capture market moves with precision, allowing you to take advantage of price swings over a few days 2 weeks. All right. So if you find this content helpful, be sure to hit that like button and subscribe to the channel for more trading insights. Now, let us get into how you can master the art of swing trading. Okay. First of all, let us start with the basics. What is swing trading? Well, swing trading involves holding stocks for several days or weeks to take advantage of price swings. Now, the goal is to capture short to medium term moves in the market by entering trades at key turning points. Now, these turning points are often at the bottoms of downtrends or at the tops of uptrends. All right, and that is where you can expect the price to move in your favor over the next several days. So swing traders aim to buy low, right, and sell high. Aim to buy low and sell high, but instead of doing it on a minute to minute basis like day traders, swing traders focus on longer price swings. So by the time you enter a position, you are usually looking for the stock to continue in the direction of the trend for a few days or even a few weeks, and then you exit once the trend starts to reverse. Now, when it comes to swing trading, the time frame you choose is essential. Swing traders typically focus on higher time frames like the 4-hour, the daily, or even the weekly charts. These time frames give you enough information to identify key trends, breakouts, and reversals without getting caught up in the noise of smaller time frames. For example, on a daily chart, you'll see the larger price trends, which will help you understand whether the market is trending up or trending down. So by analyzing these longer time frames, you are able to spot the best entry points and ride out the swing without having to monitor your position constantly. Okay, now one of the core components of a successful stock swing trading strategy is using technical analysis. All right, this helps you find the right entry and exit points by analyzing price patterns and indicators. Now, let us just talk about a few key indicators you can use for swing trading. First of all, we're going to be talking about the moving averages. We're going to be adding the 50 period EMA and the 200 period EMA to the chart. All right, we're just going to use the ribbon, but we're going to change this to EMA. All right, and we're going to change this to EMA. We're going to be using the 50 period and the 200 period EMAs. Okay. All right, here we go. So the 50-day and 200-day moving averages are two commonly used moving averages that can help you spot the general market direction. When the stock is above these moving averages, it's typically in an uptrend, and when it is below, it's in a downtrend. So currently, we are in a downtrend because the price of the stock is below the moving averages. Another powerful indicator for swing traders is the RSI, that is the relative strength index. This is another popular indicator. This indicator tells you if a stock is overbought or oversold. For example, if the RSI is above 70, the stock might be overbought and due for a pullback, just like what we saw happen here, right? The RSI was in overbought, and at that time, the stock had to pull back because of the overbought territory. Okay. On the other hand, if the RSI is below 30, the stock might be oversold and ready for a rebound. And you can see that's what happened here. The stock was overbought, and you can see that we had a rebound. You can see we had a move to the upside. All right. Finally, the MACD, that is the moving average convergence divergence. Okay, this is another indicator that helps traders spot changes in momentum. The MACD looks for crossovers of moving averages to signal potential buy or sell opportunities. These indicators can be used together to confirm entry points, providing a more reliable trading signal. Now, while swing trading can be very rewarding, it's important to manage your risk properly. Just like with any trading strategy, risk management is key. One of the most critical tools for swing traders is the stop loss order. This is a preset price level at which you exit a trade if the price moves against you. For example, if we have a bearish confirmation, you have the MACD histogram bars in the negative territory, and you have the signal line, the bearish crossover basically between the signal line and the MACD line. We have a bearish crossover, histogram bars in negative territory, and you have the price below the moving averages. Let's say you've gotten your confirmation already, and you are going to enter a sell trade. Stop loss can be above the previous swing. I take profits can be around the key support zones, basically. All right. If it's a buy trade, when you are in a bullish trend and you get your confirmations, bullish crossover, green histogram bars above the zero level, price above the moving averages, when you get your confirmation and enter a buy trade, stop loss below the recent swing low, take profit can be around key resistance zones, or you can decide to wait for when, maybe when the price crosses below the moving averages, or maybe when the MACD crosses back into the negative territory, or maybe if you're using RSI when it's overbought territory, whatever your exit strategy is. But ensure that you always use a stop loss order, okay, to minimize your losses. All right. Additionally, it's crucial to set your position size correctly. You don't want to risk too much of your account on a single trade, especially in volatile markets. Many traders use the 1% rule, which means never risking more than 1% of their total account balance on one single trade, on any one trade. This allows you to survive a string of losses without significantly damaging your capital. All right. Also, remember that part of risk management is knowing when to take profits. It's tempting to let a winning trade run, but you should have a clear exit strategy in place to lock in your profits once the stock hits your target. Setting a take profit order can help you stay disciplined and prevent greed from taking over. Now, to wrap it up, a solid stock swing trading strategy involves a combination of patience, timing, and technical analysis. By focusing on higher time frames, using indicators like moving averages, RSI, and MACD, and incorporating sound risk management practices, you'll be well on your way to mastering swing trading. The key is to stay consistent and disciplined. Do not chase after every move in the market. Wait for the right setups and always protect your capital. With practice, you'll be able to spot great opportunities and make confident swing trades. If you enjoyed this video, don't forget to give it a thumbs up and subscribe to the channel for more trading strategies. Drop any questions or comments about swing trading below. I'd love to hear your thoughts. Thank you for watching, and I'll see you in the next video.